All right, let's move on to Brennan. He's going to revisit Pyrogenesis Canada Inc., symbol PYR in the TSX. I think you've done this one or two times at least in the past. Very passionate shareholder base that we're commenting many times on this. Every time that we've reviewed it, I mean, we interviewed management in the past, and we think they're competent, and there is potential here. But again, the potential had been contract-driven business, and it really hasn't pushed forward in terms of the sales cycle that they had originally projected. And it just, the share price has been decimated, and we warned on that. You're speculating. We are more in terms of our investing, we are looking for companies that already have financials that trade at lower prices than when we originally looked at Pyrogenesis, and have the potential to have these blue sky upside events in the business. And, it's hard to find those businesses, but if you want to profit long term, that's what you should be looking for versus speculating on a company that may deliver some blue sky potential. And Pyrogenesis, not saying it's a poor company, it's just a business that still had to when we looked at it in the past, it really had to it got ahead of its skis. It really had to backfill a lot of the order book to get to the point where we'd see it had any value at those points. Now we'll see where it is at 50 cents, right?
Yeah,
Because this company was significantly higher the last several times we looked at it.
Yeah, and I'll go over like kind of the price and where it was at when we covered it, because we've covered it several times on the pod. So again, Pyrogenesis Canada Inc. (PYR) on the TSX, currently trading at a price of 53 cents and about $100 million market cap. So they design, develop, manufacture, and commercialize plasma processes and systems in Canada. It offers its Drossrite, a process for enhancing metal recovery in the aluminum and zinc industries. It's PureVap, a process to produce high purity metallurgical and solar grade silicon from quartz, and PureVap Nano Silicon Reactor, which is designed to transform silicon for use in lithium ion batteries. They've also got their plasma torches for replacing fossil fuel burners, which are more efficient from my understanding, as well as plasma arc waste destruction systems for waste destruction. And the company also provides engineering and manufacturing expertise. So, like Ryan said, we've covered Pyrogenesis on the podcast back in September of 2021 when it was at a price of about $5.33, in October 2022 and June of 2023 when it was at a price of slightly above $1, and about 1 year ago in July of 2024 when the stock traded in the 70-cent range. And again, today the stock is trading at about 53 cents per share, but was as low as 43 cents over the past few months. So the stock keeps trending lower, essentially, given its weak fundamentals. And every time I essentially concluded that the company had potential, but to us, the business just had yet to validate its business model as it continued to lack profitability, cash flow, or even adjusted EBITDA, and struggled to maintain any sort of revenue growth. So let's look at those financials to see where the company is at today compared to when I covered them a year ago. Well, for the last quarter, Q1 of 2025, revenue was down 14% to about $3 million. Net loss was $4.3 million, or a loss of 2 cents per share, compared to a loss of $4.4 million or 2 cents per share in Q1 of 2024. The company still isn't able to produce positive adjusted EBITDA, losing $3 million in Q1 of 2025 compared to a loss of $3.2 million last year. And cash flow from operations was also a loss of $2 million compared to a loss of $2.8 million for the same period last year. So the company continues to burn through cash. And looking at the balance sheet, its cash balance is now $224,000 with debt and leases of $9.2 million, providing a net debt position of approximately $8.9 million. So given the business is burning cash, how has it been keeping the lights on? Well, as you can see up on the screen here, the company had a net cash position of $23 million in Q1 of 2021, which was certainly intriguing to us. But over the years, the company has moved into a net debt position. So the company has been draining its cash balance, has been taking on more debt, and has been issuing more shares, now up to 190 million common shares outstanding, which added about 11 million shares since I covered the stock last year. And as I've been saying every single time, which has come to be true, given the dwindling cash balance, debt on the balance sheet, and lack of profitability, the company will need to issue shares once again to keep the lights on. Now, looking at the company's backlog as at May of 2025, it was 52 million, which is expected to be recognized over a maximum of 3 years. And this is up from just 28.1 million in May of 2024, but down from its all-time high of 54.4 million in Q3 of 2024. So it's obviously good to see the backlog is increasing. But, do I think that this, 52 million is now an immediate inflection point for the business? No, but, this backlog growth is certainly something to continue to monitor. And again, because the lack of net income or just any profitability, we have to value the stock off of its revenue, which right now it trades with a price to sales multiple of about 6.7 times, which is down from about a year ago of 10 times, of course, led by a declining share price. Now, last time I covered the stock, I also referenced a few YouTube comments that stated, by avoiding the stock while it continues to burn cash, we will have missed the major initial run, and that we should analyze the company's qualitative factors more in depth. But in hindsight, the fundamentals are what have mattered. And people who got in at $1 or, God forbid, at higher prices took on the risk, which, again, we're trying to mitigate. This is the risk we're trying to mitigate. So, to conclude, at this point, the risk continues to outweigh the potential reward for an investment, in our opinion, and we would continue to classify the stock as speculative, given it continues to lose money, now has a net debt position, and will need to service its debt while it remains cash flow negative, and will likely continue diluting shareholders to keep the lights on. The recent backlog growth is positive and something to keep an eye on. And if the company can increase scale and move toward profitability, we would be more interested. But for now, we continue to monitor. And I'm just going to leave you with a quote, which I've heard Ryan saying lately, which I believe comes from Warren Buffett or Charlie Munger. So don't give Ryan credit for it. But I believe it sums up a stock like this quite well. As we could look at the qualitative factors of a company until we are blue in the face, or look at the technology, but fundamentals are like gravity, and the fundamentals are what have been pulling this stock's price downward.
I'm getting I'm getting the feeling that maybe Brendan he just doesn't understand the technology.
I think so too.
Has anybody mentioned that maybe on YouTube in the comments?
I think we've seen it somewhere. Yeah, we've seen that. Definitely, we hear that many times. Many times.
Yeah, I mean, people say, well, you got to look at the qualitative factors. Of course, we look at the qualitative factors. They're incredibly important. But I don't care about the qualitative factors when the fundamentals and the financials of the business are completely horrid, right? Yeah. And I'm not pointing at any individual company here, but like if you have no revenue and no anything in the business to demonstrate that you have a marketable product or service, then then what credibility does the management have when they're talking about the qualitatives, right? Anyways.
Yeah. And Brennan got into the capital raises too, the constant equity raises. I mean, 10 years ago, 85 million, today 183, 184 million. When you continue to, on an annual basis, this company, even on an operating basis, they don't produce income. So you have to go into debt, or you have to then issue equities to fund the business, to fund just the regular course of the business and any growth. And it dilutes existing shareholders. And, they've done that significantly over time. Again, the backlog increase is something that, attracts our attention to the business, but you have to execute on that profitably at some stage. And again, we always, and I always have to say this, is we're looking at our universe of thousands of companies. So there's this company, because it does have some revenue, ranks ahead of probably 90% of those in the Canadian market. But we're looking for the top tier of like 1 or 2% of those companies that have revenues, trade at reasonable prices, have good balance sheets, don't dilute nearly as much as we're seeing here, and have blue sky potential. And though that is, there's many other factors that go into it, but those are some of the fundamental factors that we're looking for in a business. If you don't have those, we can move on to another company, even if, there can be a case that this is a great technology. And if they get the sales in one of the 4 or 5 areas that they're targeting, and it will do well if that happens. But it's a big if. You can find companies that already are and have an if there. You're going to do well if the company just operates its existing business well. There's a growth factor in those businesses that we like as well. And that is the type of business we're looking for, because we're not just looking for upside. We're looking to try to limit the downside, because you can go broke looking for upside in businesses that don't have any fundamentals under them. And this company has some of the fundamentals, but not the level of profitability that we look at. And I sound like a broken record on this. Everybody who's investing in Pyrogenesis isn't investing for a 12% annual market return. They're looking for blue sky potential. If you are looking for those companies that do 10x or 1,000%, the data shows you that 90% of them start as profitable businesses. They're small, like this company, but they start profitable. So let's see some profitability, and then you're going to be at least playing in the bucket that gives you a chance to find those 10x blue sky companies that you're looking for.
Yeah, one thing that I'd like to add too is, like, I think over the trailing 12 months, the stock lost like 5.7 million in net income. So, to generate, 6 cents, per share in earnings, the company would have to flip from, losing, 5.7 million roughly trailing to, all of a sudden getting into, profit of like 12 million in net income. Well, over the trailing 12 months, the stock has done, or the company has done, revenue of like 15.2 million. So, to get them to a reasonable valuation on earnings, they've got a lot of work to do.
Right now the stock, even after sinking incredibly from when we first looked at it, after we got questions from clients and people who watch the show, it's on a fundamental basis, it still looks expensive. So we have to put it in perspective. Now it's priced on blue sky. It's priced on the forward potential here, but just be very aware that you need this company to backfill in terms of cash flow at some point. The valuations that are there now. All right, I think that's beat this dead horse here. It's not, again, we're not saying Pyrogenesis is the worst company out there. It ranks well ahead because it has revenue of many companies we look at. We're just looking for the top tier.
I actually think that is what Brennan said.
Okay.
Well, for the YouTube comments.
Yeah, I'm going to get some hate mail.
We appreciate all the good comments and the hate comments. We love to debate on those, so keep them coming.
No, absolutely. It's great to have a different opinion. And we'll present our perspective and you present yours. Yeah.
And a lot of it there is general, not even specific to Pyrogenesis. That's what we're saying. Just the profile of the business that we are looking at that gives us the best chance of blue sky upside and the least chance of a massive downside in those businesses. And you still can't prevent that, but we're trying to.